So here's a very, very hearty good afternoon to everybody. On behalf of the Corporate Laws and the Corporate Governance Committee of the Institute of Chartered Accountants of India, I take great pleasure in extending a very warm welcome to all of you to this webinar on mergers and acquisitions and role of chartered accountants as advisors. I'd like to also place on record my sincerest appreciation to the efforts of the office led by Seema Goyal, Ms. Seema Goyal, in enabling this program. Also extend a very warm and a very hearty welcome to CA Kanakadara Srinivasan, who's here with us today, to speak to us on M&As and the role of chartered accountants as advisors. Why is this topic very relevant today? There are two ways through which owners or shareholders seek to grow their businesses. One is the organic route, which is to scale up slowly, to start from scratch and grow and make large enterprises, large and profitable enterprises, which is what is every shareholder's dream and a director's dream. The other route is to take an inorganic growth route where you acquire entities, either those where you see synergies or even newer areas, and there are, of course, forward integrations where you buy somebody like a customer, or a backward integration where you want to buy a supplier or just about any other entity. So that's the context of M&As. And traditionally, for some reason, I don't see too many CAs getting involved in M&As. And by M&A, I just don't mean only the transaction as such, but what comes before a transaction and what comes after a transaction either. And hence, I thought it was we at CLCGC thought it was very relevant to introduce these new kind of areas that I think CAs must kind of focus on more. And today, as we understand, it's chartered accountants need to transform ourselves more to be business advisors beyond our traditional attest and assurance functions. And it's in this context that may I request you to do a virtual put your hands together for Kanakadara Srinivasan, who's here with us today. And in terms of her profile, Kanakadara, or Kanak as she's called, is a chartered accountant by profession and a holder of a master's degree in accounts and finance from the Manchester Business School. She's the founder partner of Initium Partners LLP, a firm that offers management consulting and M&A advisory services. And she's earlier been part of the transaction services vertical of a very large firm with the experience of working across various domains in transactions. And why did we have Kanak over today? Because I think she's got real hands-on experience in handling services. May I request Vignesh to please, So, and her select deal experience includes Sutherland, UST Global, some work for the Tata Technologies, and she's assisted several M&A deals, whether in the capacity of performing due diligence reviews or actually helping deals get consummated themselves. So it's over to Kanakadara, and I've sort of kept this brief very simple for her. I said we'll have anywhere between 500 to 1,000 participants attending, and I'm very, very happy to extend a very warm welcome to all the 500 plus, which was there 5 minutes earlier. And normally it tends to peak until the 15th minute. So here's a very hearty welcome to all of you. And I think what she's going to do is actually walk us through a typical M&A journey itself. And at every stage where she feels we can embed ourselves. Another reason why I think CAs need to get into M&As in a big way is also because of this new law. It's not really new anymore, but it's the Insolvency and Bankruptcy Code that's come in, which is actually spurring a lot of mergers, acquisitions, demergers in the insolvency space. A potential resolution applicant may want to come and bid for a stressed asset and says, okay, I'll merge it with me. In my own case, it turned out to be a demerger. A potential resolution applicant says, I will take this project of a real estate and wanted to demerge it as part of an NCLT approved resolution plan. So in all of these, so sometimes as a community, I think we don't rate ourselves too high in terms of the competence that we have. I think the people who are best suited to advise on these transactions are essentially chartered accountants, because I think you have the commercial knowledge and acumen to actually advise deals. We have the ability to actually perform fantastic due diligences to highlight what the risk could be for a potential buyer. We also have the capability to assist other players who are actually doing the DDR, to help a company or a corporate to get ready for a DDR. And in terms of the Companies Act, so a lot of times I find more company secretaries doing M&A work because we think there's a large legal component. Actually, the legal component is not so large. It's the transaction component that's large, and the NCLT approvals or that part of it is not really large. So it's in this context, and with this very short introduction, I would put the floor open to Kanakadara to carry on with her presentation. And whatever are your questions, the secretary of the committee, the acting secretary at the moment, Seema, she will be able to guide us and put the questions to the audience, to the speaker from the audience. So thank you very much, and welcome once again, Kanak. I hope we have a fruitful.
Thank you, Shri Priya, Vice Chairperson, Corporate Law and Corporate Governance Committee, ICI, for these lovely words of introduction. A very good afternoon to everyone. I know as a fellow chartered accountant, it's actually my distinct pleasure to extend a warm welcome to each and every one of you here in today's webinar session. It's indeed an honor for me to see so many distinguished CAs gathered here today, to explore this dynamic and exciting world of M&A and, the implications that this wonderful field, has on our profession. And, without taking much ado, I'd like to get on with the topic. M&As, have, like Priya said, has become very integral, to our business landscapes. By driving growth, it's resulted in industry consolidations. It's led to a lot of transformations, across industries. And especially today, with the economy being very dynamic and, the competitive business environment, companies are actually, and more increasingly, they are turning to mergers and acquisitions as a strategic tool, to achieve their growth objectives, for their expansion plans, and also in terms of creating, value for their shareholders and larger stakeholders. As a practicing chartered accountant, I would say I've spent 95% of my career in doing transactions. And something that I've seen across all these years, which is proven time and time again, is that at the heart of every successful M&A transaction, right, there lies a team of professionals with a diversified, set of expertise and skills. You have chartered accountants, you have lawyers, you have MBAs, you have CF.
തോന്നല അത് വെറും തോന്നല മനസ്സിലാ ചോനൊക്കെ വലുതായി ആ കാര്യം കണ്ടു കഴിഞ്ഞു
Sorry, Seema, am I audible?
Yes, ma'am, you are audible.
Seema, would it be possible for you to share the screen? There seems to be some connectivity issue from my end.
Sure. Just give me one moment.
Sure. Yeah, my sincere apologies, everyone. Yeah, so like I was saying, as chartered accountants, over time, I see that we actually play a pivotal role in navigating the complexities of these deals. We actually funnel or fuel the information to our clients in helping them take informed decisions and which actually leads to the value creation in the larger M&A process. In terms of today's agenda, what we've tried to do is first we'll give you an overview of the M&A ecosystem, what is driving the need for increased M&A activity in Indian businesses, some prominent deals, some rationale behind M&A activities, typical deal structures, and also more importantly, where our role as chartered accountants, come in at each stage of the deal spectrum. And by the end of this webinar, I do hope everyone gets a deeper understanding of the M&A landscape in India and the opportunity that this presents for us chartered accountants, the skills and knowledge that we also require in excelling in this dynamic field. It doesn't matter whether you're a seasoned professional or whether you're just starting your career out. I do hope, with this webinar, you are equipped with some valuable insights and also perspectives so that, it sort of enhances our capabilities and empowers us to make a more meaningful impact in the already dynamic M&A ecosystem. Seema, can you move to the next slide? Yeah. So now, why has M&A been so important, and what is these M&A activities doing in our business ecosystem? In the last few decades, if you see the mergers and acquisitions, they've actually played a very crucial role in enabling Indian companies to expand operations, to enter into new markets, also, in fact, to acquire like new technologies, sales prospects, and also in certain cases, bring in a lot of tax benefits to companies. In fact, in the last couple of decades, there has been a significant surge in M&A activities, and we see these trends to continue in the foreseeable future as well. And statistically, I think we've already crossed a $100 billion mark in terms of total values of mergers and acquisitions that have happened, in India. And one of the major reasons why this is happening is with M&As, it helps businesses or markets to consolidate. M&As typically help you to consolidate fragmented and unorganized markets. It also helps in bringing restructuring across a lot of diverse sectors. And I mean, notably, if you see, in the past, aviation, e-commerce, pharmaceuticals, even for that matter, diagnostics business in India, couple of decades back was extremely unorganized. And now with a few large players coming in, there's a lot of consolidation and organization in the industry itself, is happening in this space. Apart from that, a lot of companies, when they're looking at inorganic growth, right, it also brings them a new avenue to access capital, technology, even in fact, managerial expertise that they require to compete, be it in their own home turf or larger domestic market or even the global market. And what we've also seen is that the strategic acquisitions of some of these technological companies, the startups, and also even some of the foreign firms that Indian companies have acquired, it's helped our Indian businesses to acquire innovative solutions, intellectual properties, specialized skills to improve and enhance their competitiveness in the market. Apart from that, companies also see this as a great venue especially if they're looking to expand into new markets, both domestically and internationally. We see a lot of transactions happening in both spectrums. They acquire established players, or you form strategic partnerships through joint ventures, and through this, they are able to get in a much more accelerated phase. They are able to get into and leverage on local distribution networks. They are able to tap into untapped customer segments, thereby reducing their own dependency on their legacy markets. Also, now what has happened is with the Indian startup ecosystem, right, which has been up and coming, this has also become a hotbed for mergers and acquisition activities. And in fact, over the years, if you see, there are a lot of established companies. They are increasingly acquiring, innovative startups to drive their growth and innovation. Also, these M&A activities have also become a main scale venue to provide exit for entrepreneurs and the investors, which is indirectly, incentivizing these entrepreneurs and to foster innovation and, fueling the larger growth in the startup ecosystem. And also, even from a regulatory reform or policy initiatives, the government is actively seeking to bring in new reforms. Like Shripriya said, IBC is one classic example, right? And also, they've liberalized FDI norms so that the transaction process itself is facilitated much smoother. And also, in the larger scheme of things, successful M&As, time and time again, have resulted in synergies, economies of scale for clients, enhances efficiencies, it leads to improved profitability and the larger wealth creation for your shareholders, employees, customers, and the entire supply chain. So that's what these are the major reasons why M&A is something which is becoming increasingly a hotbed, in the recent times. And also, like, it's very important that we chartered accountants, I would say, we are the closest to our clients, and becomes very important that we take, apart from having the hat as an auditor or an assurance provider, it's becoming increasingly important that we also take up the hat as business advisors to our clients. Seema, next slide. Yeah. So what I've done is just sort of try to bucket simplicity, in a simplistic way, kind of transactions that happen when we say M&A, right? A classic example is a merger where there is company A and there is a company B. They merge together to form a single entity, right? And a classic example here is, if you remember, HDFC Bank and HDFC Limited, I think in 2020, they merged their businesses, together as part of their parent company. A lot of their business units, like your HDFC developers, their property fund, everything got consolidated into a single entity. So that's one. And then apart from that, there is, a straightforward acquisition where companies, large companies, or even like smaller companies, they look to acquire another company outright. And in fact, in India, there have been quite a few of those transactions that have happened in the past, right from the popular one being Tata Sons, acquiring Air India back, or Reliance Retail when they went and acquired Future Group, Walmart, acquiring Flipkart, wherein because of which they immediately from get-go, they became one of the largest e-commerce players in India, competing with the likes of Amazon. Another example is like a strategic partnership, which is basically two or more companies. They come together, they set up an entity for a common goal, a joint venture, basically. And one example I will say, and one of my favorites here is, Tata Motors. As we all know, they acquired Jaguar, and then subsequently Tata merged their Jaguar business into the Tata. They formed a joint venture so that they can gain access to Jaguar's, the premium brand, right? And also the technological expertise. And then other example is divestments or a demerger, if we can say, where companies have looked to hive off maybe a particular segment or a particular product line or a particular geography, they either they demerge it and decide to run it as a separate entity, or they divest a particular segment and then they sell it to another company. And one example I would say is UB Group. As we all know, they were originally the owners of United Spirits, and then subsequently in 2014 they divested their alcohol business, and then they eventually sold it to Diageo, who is actually a global player in the alcoholic beverage space. Seema, next slide. Yeah. And there are a lot of reasons why companies resort to taking the inorganic route, right? And it's very important for us professionals also to understand and identify with our clients or with prospective clients whether there are similar opportunities and synergies, where there is an opportunity for a transaction, or even if there is a transaction, it's important that we understand the deal rationale so that we are able to advise the clients in such a way that their larger objectives are met. And when I say larger objectives, one of the primary reasons why companies look for M&A is to achieve their strategic growth. When I say strategic growth, it's expanding market share or increasing their scales, accessing new customers. M&A seamlessly allows companies to grow faster than through organic means. Like I explained, Walmart is a classic case, right? Flipkart took about 10-15 years to get to that scale where they are. And by doing an acquisition, Walmart was able to get from day one a competitive footprint and was able to operate as a larger e-commerce player in the Indian market. Other reason is we've seen companies, they as a strategy, they tend to diversify operations. And when I say diversify operations, it could be expanding into new product lines, expanding into new geographies. I'm a manufacturer of beverages. I want to get into other, consumer brands, like in terms of chips or biscuits. These are things that can be seamlessly achieved through M&A process. M&A is also a great way for companies to pursue and gain access to new technologies and IPs. And especially, this is something which has become a hotbed in the startup ecosystem. We do see a lot of companies, even from US, UK, Singapore, large established companies, they scout out and they look to acquire some of these early stage startups so that they can get a quicker inroad into some of these competitive technologies that we are developing. The other one of major drivers, what we see is driving M&A, is basically the cost efficiencies and synergies that come. Typically, two companies merging together or a company acquiring another company, there are synergies in terms of eliminating, duplicate support functions. You can consolidate operations. Supply chain efficiencies can be built and optimized. There is also combining of resources. So all these benefits, come in, and also market consolidation also happens to a certain degree with M&A, multiple M&As happening in a particular field. And also, one of the other benefits that we've seen is it actually gives access to skilled, talent, the human capital especially. And we see this in IT services companies or any service company, right, where the biggest pain point is to establish a team and sustain the team. And M&A has been a great means of giving this access to companies. Apart from this, companies also look to do a merger or a demerger or an acquisition to optimize their capital structure. There are also a lot of tax benefits and tax efficiencies that they look at by doing these transactions. And also, they also look at in terms of, when I say strategic realignment, they look at divesting some non-core assets. They try and spin off their divisions or merge with complementary businesses to try and see how best they can focus on their core competencies and strategic priorities. And it's very important that we understand deal rationales, especially when we are advising clients on any M&A deal, irrespective of in which value chain we advise them. And the other thing, and which I also feel is one of the reasons why we as chartered accountants don't spend or pursue M&A as a business vertical, is that there seems to be a stigma that M&A only happens in large companies involving millions and billions of transaction value, and it is not the case. Like I said, there are a lot of M&As that are happening in the startup ecosystem. There are substantially a lot of deals that are happening in the SME space as well. And unfortunately, some of these smaller companies, they are not able to get the right advice because a lot of CA firms, we limit ourselves to giving, tax and audit advisory. We don't explore this, although we do have the capability to do it. And if they have to go to a larger firm or an international firm, then financially it doesn't become viable for them. So it doesn't matter how big or small the companies, transactions are happening across all sizes and verticals. And India right now is in the hotbed of this whole M&A ecosystem. Seema, next slide, please. So what I've tried to do here is to sort of try and give you a view on how typically these M&A deals happen, right? So we previously saw, right, there are mergers, there are acquisitions, there are joint ventures, there are even divestments. Now, these typically happen through one or more of these four modalities. One being a slump sale. I think slump sale, most of us are familiar, right? It's something that we see from an income tax perspective as well, where any company can acquire or a company can sell its entire undertaking as a going concern, in a lump, as a slump sale, without assigning any value to its individual assets or liabilities. You just pack the whole business together, and then you sell the business as is on a going concern basis to a buyer. In this instance, the business gets sold, the selling entity or the divesting entity is there. It's just that the business is taken out of that entity and then it's sold to a prospective buyer. And here, the slump sale is something which that is kind of sensitive. The definition of slump sale is something that tax officers look at very closely. And us as chartered accountants, it's important, especially when we are working on an M&A deal and where they are envisaging to do this deal through a slump sale. And if you're advising especially the sellers, it's very important that we ensure that the definition of slump sale from an income tax perspective is, met. Another way through which deals happen is they basically pick and choose assets and liabilities. And when I say assets and liabilities, it's not just physical assets and liabilities, right? It also means your brand, your IP, customer contracts. So they assign values to it, and then it just becomes a simplistic sale of net assets to a prospective buyer. And there are also deals where there is no transfer of assets or liabilities or contracts from business A to business B. The buyer basically goes and acquires the shares of the seller's company. There's just a transfer of shares that happens between owners, and then the transaction gets consummated there. And apart from that, of late, what we also see is that when deals happen, the flow of consideration between the buyer and the seller is not just limited to these three mechanisms, right? There are also transfer of consideration, which effectively goes in other forms, such as giving a non-compete fee to the sellers for adhering to certain non-compete provisions for a certain number of years. Exit fees typically get paid to CEOs and CFOs if they successfully consummate a transaction and give exit to investors or startups. There are also deferred considerations that are extended, especially in cases where a transition is requested by an acquirer for a certain number of years, in which case there are also modalities where you see, while there is a consideration initially that is given for the sale of the business, there is also some deferred consideration that comes over 2 to 3 years or 5 years to the management of the team or for some residual shares, which gets eventually sold in the remainder of the period. Seema, next slide. Yeah. Now, typically, irrespective of whatever kind of deal it is, the process more or less is same. What kind of changes and what is important for us to consider in any deal process or deal cycle is who's that we are representing. Are we representing the buyers or the sellers? The second thing is, at what stage are we advising our clients? And when I say stage, we can broadly bucket it into a pre-deal stage, then there is a deal stage, and there is a post-deal stage. Typically, when we say pre-deal, this actually starts with deal sourcing or deal origination. And it sort of goes into the strategic planning, which we earlier discussed, right? There are certain underlying drivers which trigger the companies to look at inorganic M&A route for growth. So clearly chalking out the objectives of, going for a deal, how to go about with the process, identifying what kind of companies that we should go scout, whether it should be in India, whether it should be in a global market, whether it should be a large company or a small company, should it have, what should be the quality of governance that is there in these companies. So our role as advisors actually start right from this planning phase. In fact, if we are representing a buyer, chartered accountants are actively involved in forming or strategizing on the larger deal thesis. They help in putting together a lot of presentations around the profile of the assets that they are looking at, what are the risks, what is the underlying business plan, what will be a business plan and resultant synergy, let's say if a deal happens, right? And even if you're advising on a sell side, again, the role for a CA starts from get-go. Because in a lot of instances, companies are required to present a financial model or a business plan. They are asked to prepare a brief information memorandum talking about the business and the USPs of the business. So these are things that chartered accountants are assisting from get-go. Also, we can drive the entire process, the entire spectrum of the deal as a deal manager or an investment banker, like we all like to say it. And it is not just that, MBAs are investment bankers. Chartered accountants also make great investment bankers. I'm an investment banker myself. And there are quite a few successful bankers, in India who are chartered accountants. So in terms of opportunity, right from get-go, if it's a pre-deal stage, we are actively doing, if you're representing a buyer, there is also a lot of risk assessment that happens in terms of assessing the quality of asset that you're looking to acquire. And like I said, from a sell side as well, chartered accountants being close to the company, we see that they are able to also identify some of these risks well in advance. And, we are able to sensitize the promoters and also, navigate the deals better if these risk assessments are done well ahead in the transaction. And then from a deal stage itself, typically, 99 out of 100 deals actually happen with a due diligence. And when we say due diligence is not just limited, to a legal diligence. Almost all companies do financial and tax due diligence. And this is where us chartered accountants play a pivotal role. And I think its diligences are typically conducted by chartered accountants. And this actually helps clients to assess the target, assess the company's financial position, legal aspects, operational aspects, assess the financial strength of the company itself, also helps us get some assurance in terms of revenues or the underlying margins that, the targets showcase. And apart from that, if you're running the deal itself, we sort of identify potential issues that can have a bearing on closing the transaction itself. There could be some license that the company doesn't have, which, the owners of the company may not be aware of, right? And these are things that we can pick up well in advance, advise the seller or the buyer, so that suitably this can be sensitized, to the other party. There are also, instances where there could be, an interim year. The numbers may not have been audited. All the more diligence becomes important. And diligence sort of is a follow through from an audit, right? So from audit, we deep dive. So as chartered accountants, we all have the capability to do a financial due diligence. Seema, I think you're on the... Yeah, thank you. Then going to the actual deal itself, typically once a diligence is completed, what actually happens is, based on the diligence findings that we give, there are subsequent negotiations that happen between the seller and the buyer to agree on the larger terms and conditions of the deal, including the purchase price, how the structuring of the payment will happen, how the deal will be financed, and how the deal itself, will be structured, whether it's going to be a slump sale or whether it's going to be a share transfer. So here, the diligence that we do actually forms a significant basis for the kind of discussions that actually happen in the deal finalization stage. And here as well, while although even if you're engaged to do a due diligence exercise, the role is not generally expected to stop there. Clients do expect us to give our inputs in terms of how to go about and how to negotiate with the other party and some of the risks and benefits that we see. And therefore, it becomes, very important. Also, the deal structuring itself, in terms of what structure do we take for the deal, and how to optimize tax for both parties, right? There could be GST, there could be income tax. And this is something which is again a hotbed for us chartered accountants in terms of doing deal structuring, specifically around the tax structuring itself, to optimize tax for both the parties involved in the transaction. And then once that is done, our support also extends to assisting the legal counsel in drafting their transaction agreements, right? And here, again, the feeder for a legal counsel to draft a good investment agreement also comes from the diligence exercise that we carry out, the risk assessments that we have done, or the business plan that we have built. And again, here in terms of navigating through the deal contours in the agreement, chartered accountants are, as bankers, you are expected to do the negotiations and assist the legal counsel in drafting the agreements. And apart from that, there is also quite a bit of work that happens in closing the transaction as well. Typically, what happens is, once the diligence is done and the negotiations are done, the agreement is drafted and executed. But that doesn't mean a transaction is done. Once the agreement is executed, there are certain activities which is agreed between both parties to be completed. And only then the deal gets consummated by transferring the consideration, which we call as closing activities. And these closing activities are it could be something like a regulatory compliance or a regulatory filing that we have to do, or it could be something in terms of clients closing a credit line, or it could be for them getting a particular license. It could vary based on the transaction. And even here, especially if you are advising on the sell side, the companies look for the support of the chartered accountants to assist on the transaction closing. And once the deal is done, it's not that the role stops there. M&As are typically like marriages. So the work starts after the knot is tied. So there is a lot of work that actually happens post-transaction in terms of integration and monitoring. So when I say post-merger integration, it involves, it's a continuous ongoing effort to integrate operations, integrate functions, integrate business cultures of two entities into one. And it's not just in case of a merger, right? Even if I acquire a company, the DNAs have to sync at the end of the day. And only then, companies can typically achieve synergies, strategic objectives. Company A may be reporting in a particular fashion, whereas the seller company may be reporting in a particular fashion. So those things have to be streamlined. The SOPs which are being followed for various business processes tend to be different. Those things have to be aligned, which means it also involves people change. And also, once you do the transaction, the asset that we acquire, there is also a lot of monitoring and evaluation that goes to track the progress of the asset and against the initial deal thesis that we had or the initial business plan that we had before we consummated the deal, right? And then see whether we are on track or whether any adjustments have to be made to optimize the optimize and get the desired outcomes. And here again, CAs help in routinely supporting clients, be it the seller or the buyer, in terms of the ongoing integration exercise or monitoring exercise. And one very big scope that we see is, especially in an environment where a large company is acquiring a smaller or a mid-sized company, these large companies tend to have big ERPs, like your Oracles or SAPs of the world, whereas a smaller company may be relatively using an off-the-shelf package like a Tally or a Zoho. So there has to be an ERP implementation that has to happen in a small or a mid-sized organization immediately after the transaction so that the accounting systems are aligned. And this is one area where, while the implementation is something which is technical, the functional expertise actually comes from chartered accountants. And there is a lot of work that is happening, especially on this space when it comes to integration. And apart from that, there are several filings that we'll have to do, with MCA, conducting board meetings, making sure the filings are in order. A valuation report is, required, be it from a Companies Act perspective or income tax perspective. And as registered valuers, we chartered accountants can, support on the valuation exercise. So, to sum up, like I said, the opportunity for us as chartered accountants is there right from the beginning, from the ideation aspect of M&A till such time the deal is closed, and even after post-closing, for a certain number of period, there is a hand-holding that is required for companies. And irrespective of whether we assist a seller or a buyer, we have the capability, and currently a lot of CAs are up and coming in providing these advisory services to companies. Seema, next slide, please. Yeah. So sort of to sum up what we discussed, what I've done is I've sort of bucketed each deal phase and sort of given a flavor in terms of what is that we chartered accountants can offer as services to our clients. From deal origination or identification, corporate finance is what we call it, corporate finance, investment banking, what we call it. So there you handle the entire spectrum of the deal, right from identifying a potential buyer if you are hired by a seller, or identifying a potential seller if you're hired by a buyer. You do deal profiling, you scout for targets, you preliminarily do a risk assessment of these companies, give a high level view on valuation, prepare the required collaterals that has to be given to the board or the top management. If it is a small promoter run company or an SME which doesn't have a robust CFO function, then our role here also starts much ahead in terms of sensitizing them in terms of what are the negotiation points, how to go about it, whether it's something which is customary in the industry or not, helping them prepare and give initial information that a buyer might require. In due diligence, as chartered accountants, we can do financial due diligence. We can also do secretarial due diligence. We can do tax due diligence. Due diligence typically is not just something that is being done from a buyer perspective. A lot of sellers especially, if they are looking to go to the market and sell in the future, they hire us to do a vendor diligence also. So a diligence can happen both from a buy side perspective and from a sell side perspective, right? And apart from that, even let's say in a particular transaction, there is a buyer who's appointed a diligence team. And in multiple cases, especially in India, we see SMEs and promoter and companies, the teams are not equipped, or they don't the accounting team that typically graduates, right? They're not chartered accountants, or they won't have a CFO, or they may have bandwidth issues. So they struggle in understanding the data requirements that come from a diligence team, or addressing any queries that come from a diligence team, or putting together the data in a certain fashion that diligence team wants. And this is something that as chartered accountants, especially with companies that we're already having an existing relationship, if they're going through a transaction, we do something called a vendor assist, where you can actually assist the company in going through the diligence process. And as you do this process, you'll also be able to get a sense on what are some of the potential risks that can come up, or what is any issues in the quality of data, which can then be suitably sensitized to your client, and also that can be then suitably communicated, and some comforts can be seen, how comforts can be built to circumvent some of the data limitations and progress with the deal. And diligence and this vendor assist is one of the major areas currently where there is a want for good chartered accountants. And like I said, it's only large company, and typically it's only international firms or very large firms that actually do due diligence. Whereas this is something which is a subset of audit. It follows with our audit knowledge. And there are very limited firms that currently do diligence. And unfortunately, a lot of companies, they're not able to do a proper diligence process because they can't afford a large firm, a significantly large firm. And there are not many mid-sized smaller firms, who are doing this. And even some of the large legacy CA firms, they just focus on, tax and audit, and they don't look at diligence as an advisory practice. Apart from that, in terms of valuation, negotiation, and the actual deal structuring itself, like I said, every transaction warrants a valuation report, either under Income Tax Act or FEMA or Companies Act. And as chartered accountants can, register, they can issue the valuation report as CAs. And if we have the if we have the certification from ICAI as a registered valuer, then you can also give a valuation report as a registered valuer for these transactions. And also, we can do a lot of work in giving the tax structuring for the transaction itself. Whether a slump sale is more tax efficient, or a share transfer is more tax efficient, or a combination of 2-3 modalities where I do part slump sale, I do an exit fee or a non-compete fee. So those are things where there is huge potential for CAs, and us CAs are the ones who are actually equipped to take up these kind of structuring engagements. And structuring also happens, it becomes more relevant where a lot of these overseas companies, come into India, and where they are not too familiar with our local tax laws. So that's again where they look at chartered accountants to help them go about with the transactions. Obviously, the entire deal negotiations and everything is something that as an investment banker, chartered accountants can do. And apart from that, even if you're not doing a corporate finance function where you handle the entire deal process, there are opportunities where we are hired, as a resource or on a project basis to support, let's say, on a transaction closing, to help the client go through these closing activities to ensure the transaction gets consummated quickly. We also help in doing the regulatory filings. That is another large opportunity. And apart from that, typically we see companies preferring chartered accountants to be engaged either in the seller side of the company or the buyer side of the company, to do the integration and monitoring for certain months or years after the deal gets consummated. So these are some of the opportunities that we can look at. And like I said, it doesn't matter. You have similar opportunities whether you're advising on the sell side or whether you're advising on the buy side. Now, while opportunities are enormous, one of the key things that we will have to look at is like how we uphold our independence when we do a audit or an assurance engagement. It becomes very important for us also to ensure our independence in any M&A engagement. And this is something which institute also insists us to do. And we also as professionals have to exercise our professional judgment, and then taking that call on independence before we take up any engagement when it comes to M&A. At the end of the day, it is a transaction. There is a sizable amount of money involved as far as the clients are concerned, so that it gets all the more sensitive. And for us as professionals, we need to make sure that we are absolutely independent, irrespective of what kind of role that we take. So a few things that we need to assess when we look at when we are presented with an M&A opportunity is first, we'll have to evaluate our existing relationship. That is, whether are we representing the sellers or the buyers? What is the existing relationship that I have with the client? Is he a new client, or do I have an existing engagement, or am I providing some consulting work? What stage or what role in the deal cycle am I being asked to take up? Those are things that we will have to assess. You don't want a situation where we are the statutory auditors of the company, and then we ourselves do a vendor or a seller initiated due diligence, which means I will be the auditor and I will also be reviewing my work as an auditor when I do my due diligence. So that's an outright conflict. So that is something that you may not want to you'll have to assess to see the conflicts. And typically those are not things that we take up, right? So you don't end up doing a self review of your own work. We should also evaluate whether there are any financial interests or any ownership interest or any financial ties that could create a conflict of interest or impair our independence. So for example, I may not be an auditor of a company, but I may have some stakes in that company which is proposed to be sold. Then I may not want to take up any kind of diligence engagement or a valuation engagement, because I have an inherent financial interest in that particular asset. And like I said, you'll have to look at what engagements we are providing, whether it's audit or non-audit. If you're providing audit, especially on the sell side, and if you're being hired on by the sellers, then it becomes all the more important to very carefully assess the independence risks or whether there are any conflicts. There are also instances where we'll also have to evaluate whether there is any family or a personal relationship with any individuals or teams who are working on the M&A exercise, which can potentially impair the independence, right? It also sort of expands in terms of seeing whether, and it's not just a relative in a strict sense, right? It could even be a good friend and of an executive, a senior executive, or a director, or any of the advisors of the buyers or the sellers. I mean, for example, if I'm on the buy side, if I'm advising the buyer as an investment banker, and then the seller is going to be, let's say, my relative or a close friend, then that is a outright conflict for me, and that is something that I will have to highlight to the buyer. And if there is a conflict, then better that we step aside. But the assessment doesn't just strictly go in terms of financial interest. We'll also have to look at these softer aspects, because M&A in a larger sense involves a lot of negotiations and coming together on a lot of points between two parties, and therefore independence becomes all the more important. And also there is a big exercise that gets done in terms of getting comfort on the underlying revenues or margins or the business drivers. So these are all kind of assurances that we do through M&A, so that the independence becomes important. There are also instances where we've seen typically when we chartered accountants are engaged on a transaction, what happens is the buyer, they sort of seek out and they say, hey, why don't you join our company, or take a extended role for like 1 or 2 years, which can potentially impair or influence our independence and objectivity. So those are things that are those are also some things that you should be mindful of. If there is an opportunity that is extended during the course of the deal, where the buyer comes and says, I'll give you a job, and then you're advising on the seller, those are things that we'll have to suitably see and take up or not take up, assessing our independence on the engagement. We should also be mindful of the guidelines that's given by SEBI and ICAI. There are several professional standards that we follow. Even when we do diligences, we do follow a lot of guidances that's given by ICAI in terms of auditing standards. We also look at the accounting standards, and we try and see whether these accounting standards are applied by the company that is being subject to any due diligence. It is also goes to us following the ethical considerations that has been given as guidelines by laws and guidelines by ICAI. So these are things that we should also consider. And like any assurance engagement, while M&A may not be strictly assurance, it's important that you carry out your independence assessments, and you also document the exercise that you've carried out and the conclusion that you've reached. It's very, very important in M&A, as important as it is in audit. It's that much more important in M&A as well, because like I said, there are multiple parties, and while we are, for all practical purpose, representing either a seller or a buyer, the profession demands that we stay independent, such that the optimal value is received, or optimal value is created for all stakeholders in the deal ecosystem. And that's the expectation, or that's the standard that the industry has for us, and that's something that we'll have to uphold and keep. Yeah, going to the next slide. And so one of the things I also thought it's important that we touch upon is how to sort of funnel our growth, and also look at M&A as a specialization. This is something that I also have some of my personal experience I thought will help. As a chartered accountant, like I said, from an early stage, I started focusing on doing M&A. And unlike a lot of other spectrums in finance and audit and tax, there is no hard and fast literature to say this is how deals have to be done. Right? Each deal is different. Each deal comes with its own complexities, issues, risks, challenges. The companies will be different, the size will be different, the sectors are different. So unlike, it's not something which is routine in nature. It's very dynamic. I mean, till date, I have not found 2 deals which are similar. Every deal has been very dynamic, very interesting, and every deal, at the end of the day, there'll be something to take home. So here, certain things I thought is very important for us to grow our career as M&A professionals, to build our core competency in M&A is, one is we have the core competency in CA. We can also look at doing some more additional certifications that the institute offers. Like I said, valuation is a classic certification course that we can take. It helps us deepen our knowledge on valuation. We can take some certified courses on M&A advisory, or we can look at a lot more other courses. Look at doing more, CPE programs, because here a lot of our learning, one comes from deepening our theoretical knowledge in various aspects of M&A deal, because at the end of the day, everything has to tie together. So while we may be experts in audit and diligence, it's also always good to also gain some knowledge on valuation, or gain some knowledge on corporate finance, or we can even take some soft skill, courses to improve our negotiation skills. The second, which I think for us as M&A professionals, the greatest learning actually comes from an on-the-job experience. Like Sri Priya mentioned, I worked with a large firm in their M&A practice for a few years. And then that sort of gave me the foundation. But then, like I said, even after starting my own practice, there is a learning on each and every job, on each and every deal that you do. So that is something that it's important. Another thing that I've also seen that helps is also reaching out to your fellow chartered accountants, because they might have experienced certain things in their particular transaction, right? Where if you have a problem, if you are stuck, you're not able to find out how best to go about with a particular risk or issue from a deal. Usually talking to somebody senior, talking to a mentor, or talking to some similar like-minded professionals in the field actually helps. The other thing that really helps on improving our spectrum here is networking and mentorships. It's very important that we build strong professional relationships with people who are in the M&A field. And this doesn't just limit us to fellow chartered accountants. It could be lawyers, company secretaries, IB professionals. It could be other chartered accountants or boutique investment bankers. It's important that we build these relationships, because there's a lot of knowledge sharing that typically happens with deals, because no single person will have answers to all the questions that come up in a deal. Also, mentorships are a great way to go about with sort of mining into a M&A practice. And it also becomes very important for us professionals to be ahead and be stay informed about the industry, and especially in a lot of cases you will see M&A resources who will focus on specific sectors. Someone might just do IT services, someone might just do financial services, some might just do healthcare. But having said that, you can also have an agnostic sector view as well. But here our role is just not auditing, right? We're advising the client on on acquiring a company to see whether a larger strategic objective is met, or we're advising a seller, and this boils down to the right from the question of, do I even have to sell? Why am I selling, right? Or why am I getting into a partnership? Why am I divesting 50% of my stake to get a global player to come join forces with me, right? So these are all questions which are where we will have to give the right information to our clients, right? And that's where we become we sort of also take the role as a advisor to the transaction. And it becomes very important that we stay highly informed and up to date in terms of industry trends, market dynamics, regulatory changes, especially on the tax front. We've seen in the past, right, with Vodafone and everything, the tax incidences came. It's important that we stay updated on all this. And not just this, we also need to be sort of in tune, or we also need to have a good understanding of some of the emerging technologies that come. Because like I earlier discussed, one of the major reasons for large companies looking at acquiring startups is also they're trying to understand whether they can get ahead in the technology or IP development. And that's one area where they are looking to acquire companies. So for us, it's not just, we just don't stop with numbers. It becomes important that we understand the industry dynamics, the market dynamics, and we also understand what emerging technologies are there, processes are there, systems are there, which companies are adopting, how are they adopting. And that again sort of helps you give put that advisor hat and advise your clients in terms of how, if they're doing it in a certain way, we can go and advise them saying, you don't have to do it this way, you can do it in a better way. There are already these companies who are following these processes or systems. And obviously, like I said, this is a practice which 150% requires us to have a continual learning and adaptation. It's extremely dynamic. It just keeps evolving year on year. So it's important that, we continuously learn through a lot of these CPE programs and, all these webinar initiatives that we do. I think that's been one of my, source from a learning perspective. Be, updated on regulatory requirements, industry best practices, and yeah, always be curious in, learning and talking to fellow chartered accountants. And I think that helps contribute a lot in our professional growth. And I feel these have been some of the core areas which I've personally focused on, and I've done more than 150 transactions. And this, I hope will help you position yourself as an M&A professional, and also advance your specialization in in the M&A sector itself. Yeah. So I mean, with that, we sort of concluded the presentation. I'd like to just take 10 minutes to kind of summarize some of the key takeaways for us. One, like I said, as professionals, successful M&As are where I've seen there is a lot of value add that comes from chartered accountants, and pretty much every deal involves us getting involved in some spectrum of the deal to add give various value adds, be it in terms of diligence, be it in terms of valuations, be it in terms of filing or structuring. And it doesn't matter whether the company is big or small. M&As happen across industry verticals, across different sizes of companies, right from a pre-revenue startup to a established company which is clocking in several hundred crores of business. So that is something we should be mindful of. And the other part is going and identifying the deal rationale itself. And as if you are having an existing client, and where we see there is a particular opportunity for our clients to expand, let's say geographically, or have a product diversification, and there is a good asset which they can potentially look to acquire. Those are things where you can take your advisory hat and advise the client as a banker on going about with the transaction. And like I said, independence is very important. And actually, apart from independence, confidentiality is also extremely important when we do any kind of work in an M&A transaction. It is extremely sensitive, especially when the company is going through the process of a transaction. Because let's say hypothetically, a company is trying to acquire another company, and the customers of the seller company come to know that, okay, he is in talks to sell his company to someone else. Then there can be some apprehensions. Or the employees may have some apprehensions. They may not know what their future is. While these are things which get addressed as a transaction fructifies, any premature leakage of information about any transaction can be highly damaging, be it to the buyer or to the seller. So independence is something which is very important, and confidentiality is equally important. I'm sorry, I should have touched upon it earlier, but I would emphasize to all my fellow professionals that we uphold independence and confidence on the highest cadre, especially when we're advising on M&A transaction. And that also gives trust to our clients when we showcase these best practices, be it on confidentiality or be it on independence. And then apart from that, like I said, M&A is very dynamic. It is very interesting. You will never find two deals to be similar. There is always learning on every deal that we do. So it's important that we stay updated through continuous learning, be it on the technical side, be it on the industry side. And it's also very important that we as chartered accountants collaborate with our fellow chartered accountants and other professionals in the M&A spectrum, be it lawyers or company secretaries or IBC professionals, so that knowledge sharing can happen and we can deliver our work the highest standards possible. Yeah, so I'm done with the presentation. So maybe we can take up some questions.
Yeah, sure, ma'am. I'll just look out the questions the members have posted.
Sure.
Yeah, ma'am. The first question we have is how do regulatory and compliance issues impact merger and acquisition transactions? And what role does CA play in navigating these challenges?
Okay, so regulatory matters. So let's bucket it. So when we say regulatory, there is regulatory one in terms of FDI. If there is a inbound or an outbound transaction that is involved, right? Either a overseas company looking to come and invest in an Indian company, or an Indian company looking to go outside and acquire a company outside. Or it could be a joint venture between an India and a non-Indian company. So there are FDI regulations that are involved. Then if any of the entities are listed, then there are SEBI regulations involved. I'm just trying to bucket what all the regulations can typically come up, right? Then obviously there are tax regulations that we will have to see from a capital gain perspective or a slum sale perspective or from a GST perspective. And depending on whether the entity, depending on the legal structure of the entity, some of the Companies Act regulations or your LLP regulations or your partnership regulations can get triggered. If I have to give a few examples, now there are FDI restrictions, right? There are FDI restrictions in terms of certain sectors where companies are prohibited to acquire more than a certain stake. 100% acquisition is allowed only on specific sectors, right? So these are cases where it's important that we understand what regulatory aspects we will have to look at. If it's going to be a transaction that is going to involve an overseas player, definitely FDI regulations and FEMA regulations are something that we should be mindful of. And, in case of a restricted sector, before we progress with the deal, we will also have to get an approval from RBI to pursue with the deal. And we've seen it in the past as well, deals not going through because you would have not got an approval because the ultimate beneficial owner of that particular company could be a Chinese company or a company bordering the Indian Indian borders, right? Like which is a recent regulatory this thing that they passed. Also, one other example will be on the tax front. Very recently, the tax authorities, they amended the tax laws where they said purchased goodwill cannot be amortized and we cannot take the amortization benefits. So it's important that while we are planning or strategizing a deal, it's important that we look at what regulatory aspects would trigger. And typically in all transactions, your tax laws and your MCA laws will get triggered. SEBI and FEMA applies on a case-to-case basis. SEBI also has certain restrictions on what is the valuation that you can fix. There is a floor valuation. You cannot go below that floor valuation. So these are things that we should be mindful of when we are assessing the target. And it's important that we assess this as early as possible in the deal stage, in the pre-deal stage itself, so that we don't get to a point where a deal gets stalled because of regulatory issues. I hope that answers the question.
Yes, the next question we have is how can financial experts mitigate cultural clashes and employ moral issues that often arise during merger and acquisition integration? I'll just put that in the chat box also.
Sure. Yeah. So one of the cultural differences can stem on account of multiple things. But if we have to look at it from a phased out perspective, the first people impact come when a deal typically gets announced to the organization, right? The top management announces the deal to the employees, and that becomes, very important. And that's where our experience as deal makers becomes important. When and how the information gets communicated to what levels in the organization becomes important. The second thing is it is where it's also very important that when we assess a company, we not only just look at the business itself, right? It becomes important that we assess what the salary structures are in company A vis-a-vis company B, how similar or different it is, or what are the SOPs that are getting followed. Typically, the resistance to change comes because I've been used to doing certain things in a certain way. Suddenly, there is a newcomer in the picture. He is asking me to do something different, right? And that's where the integration becomes extremely important. So the first step is communication. The second step is integration. And when we say integration, it is integration in terms of processes, integration in terms of systems, integration even in terms of the monetary benefits, because you cannot have, three members, two from company A and one from this acquired company B on different pay scales, right? These are things which typically cause the friction. And that's where CAs become very important, because especially if you're advising on the sell side, the dynamics of the team. You would have interacted with a lot of these employees. You'll have or the senior management of the sellers, and then you sort of transition this into the newer ecosystem. Slowly over a phased manner becomes important. It is an exercise by itself, and in fact, the first 100 days from close onwards is considered very sensitive. So like I said, we'll have to ensure, or we have to plan how the communication goes out, at what time, to what levels of the organization. Second, even before the deal closes, it's important that we understand and assess what are the disparities, be it in terms of pay packages or be it in terms of employee benefits and policies, or your standard operating procedures, the systems that you use. And we have a plan so that and people will feel there will be some resistance to change, but if you have things planned, it's easier to give them the comfort that it's not going to change drastically. Over time, over training, everyone will sort of settle in, and that's historically that's worked well. Planning in advance for these disparities and trying to have a plan before the deal closes tends to have a higher success ratio on post-merger success.
Okay. Next we have is, can you elaborate some still under the perspective of GST?
Okay, so slums. Okay, so now a lot of companies. So when we say slum sale will have to follow 50B of Income Tax Act, where we look at there is the entity, and the entity has a business. The business may have certain customers, certain employees, certain IPs, assets, liabilities, borrowings, cash. What we try and do is, when we say a slum sale, is we don't look at all these micro elements. We just say this is a business. This is a business where I sell water bottles. I want everything which is part and parcel of this, which is inherently required for me to take it and I sell it. Right now, there are typically what happens is, when I do a asset sale, now instead of calling it a slump sale, if I just look at, okay, I have receivables of 10 crores, there is payables of 5 crores in the business, contracts are worth another 1 crore. So I will pay 6 crores for the business and I acquire, right? Which means I am assigning individual value to each asset or liability, and then I'm buying it, right? So whatever I pay and whatever is the difference in my net book value is something that I pay not just income tax on, but I will also pay GST, right? So GST gets triggered in any asset that I sell, and it's not just limited to physical assets. It could be transfer of AR, it could be transfer of contracts, transfer of IPs, right? So that is something that we should be mindful of. Now, specifically, GST from a slump sale perspective, right? If I'm not going to do an asset sale, and if I sort of fulfill all the criterias of a slump sale, right? Then we can look at reducing this GST incidence, right? So, in the context of GST, what we are trying to see is your GST doesn't get triggered when a slump sale typically happens. So, a lot of companies, that's why they look at doing a slump sale vis-a-vis an asset sale. Whereas from a transaction risk perspective, it's more efficient for companies to do an asset sale instead of a slump sale, because in slump sale, you cannot pick and choose what asset or what liability you want. You have to take everything holistically. Whereas in asset sale, there could be certain historical liabilities which have no relevance now, which you can completely carve out. But slump sale is something which a lot of companies look at because the GST optimization happens there vis-a-vis an asset sale.
The next question we have is whether a company can raise the new fund round with new valuation when there is already a merger processes going on, whether the swap ratio agreed on the date of application holds good, or NCLT asks for the new valuation as on the date of the hearing.
You will have to disclose it to NCLT, and your valuation cannot be materially different. If you have assessed a particular value, and I'm presuming that we are talking about both the trigger events happening within, like, let's say, a 3 to 6 months span of time, then your valuation cannot be materially different. Obviously, your valuation will be different, but it cannot be significantly different, because typically new infusions into the company tend to come at a higher valuation than a secondary transfer. When I say secondary, money doesn't come to the company. I just buy your shares, right? I'm just transferring your ownership to me, and I'm paying you a consideration. So that valuation typically tends to be different from the valuation that I assign when I do a primary infusion, where an investor comes and puts in money into the company. But it cannot be significantly different. And if it is different, it still has to be disclosed to the NCLT.
Next is, what is the approximate time period from start of deal to the closure? Is there any specific maximum time frame specified under any act?
No, there is no time frame that is specified to consummate a deal. It can vary. It can. I mean, there are deals that have got closed, as quickly as 2 months, to there are deals that have gone for like 18 months. And when I say this time frame, it's right from deal origination till ultimate closing. The only area where you'll have to be mindful of on the timelines is the timelines that, as principals, you agree in the investment agreement, right? So there will be certain timelines that will be specified by when we will have to conduct those requisite board meetings, or there will be certain timelines that would have been given for us to complete certain tasks to close the transaction, right? So they could have said, okay, from execution of the agreement, a particular license has to be obtained within, say, 60 days or 80 days. Then you are bound by that agreement to complete that task within the timelines. Otherwise, there is no statutory timeline to consummate the deal. Apart from that, other timelines that you have to be mindful of is conducting those board meetings, conducting those EGMs within those specified timelines. If it is, an FDI transaction where money has come in, then you have to do the requisite filings with FEMA within 30 days of the money coming into the company. So to do the deal itself, there is no statute or timeline, but there will be a particular regulatory requirement that might get triggered at each cycle, especially on at the time of investment signing and transaction closing. There we have to be mindful of what timelines we have agreed upon in the transaction agreements, and also the timelines that the statute mandates us to complete the regulatory filings. So that's the only things that govern the timelines.
So next we have, it is generally observed that official liquidator who are government employees are having non-financial background, and they're not well versed with accounting standards. Very often EOM and OM in auditors report, well explained in notes by the company, are seen by official liquidator as aspects of negative impact. So in case appeal is only solution against NCLT orders, as NCLT members upheld the views of official liquidator and reject merger petition, what chartered accountants advisory role in this aspect can be visualized?
Chartered accountants or also on a lot of tribunal matters are looked at, experts. So when we file appeals, there is you can always take an expert opinion from a chartered accountant to talk about the financial position of the company. And also the other thing that I've also, the point that you're saying is well taken. Unfortunately, there are a lot of employees who are people with non-financial background, but we also see that they also try and take help from CA firms. Some of the resources, they do understand their limitations. They come to chartered accountants where we try and give them the true picture. But for whatever reason, if it is not factually stated, then yes, the only route for you is to appeal. However, where it can come in handy is you bring in a chartered accountant's report as a expert opinion, and that carries a lot of weightage in NCLT forums.
Next is, what is the ideal time frame to measure the post-merger synergy achievements, implications on merger order in case of non-achievement of benefits mentioned in the merger scheme?
See, ideal time frame, it's something that will vary deal to deal. And it'll also have to be, what is, how the merger scheme has been approved. But typically, I would say at least 6 months, is a reasonable window. But like I said, it varies transaction to transaction. It varies on what has been agreed upon as part of the merger scheme. And implications in terms of non-achievements, again, that is something that we will have to, it's a disclosure, right? And then it will depend on what kind of breach we have or what kind of non-achievements we have. And then accordingly, we will have to look at it.
Okay. Next we have is, how do chartered accountants contribute to the due diligence process in the merger and acquisition transition?
Yeah. So when as far as due diligence goes, smaller transactions have typically a financial, tax, and legal due diligence. Large transactions, apart from financial, tax, and legal, they also have HR, environmental, IT due diligence, commercial or industry due diligence, which they do. For us, chartered accountants, a key role in the financial and tax due diligence. And what we do as part of due diligence is there are two aspects, actually three aspects that we cover in terms of giving information to our clients. One is giving an assurance that what the target is reporting as revenue or margins is actually the underlying, and not just the underlying margins, but it's also the sustainable margins. So let's say a particular company has recorded 100 crores of sales for the last 3 years, and the margin is something that has been declining from, say, 15% to 10% to 5%. We don't stop with saying, yes, 100 is 100, 15, 10, and 5 is 5. We also go further, assess the business, and go and tell the client saying, hey, this 5 is not going to be 5. They've been, historically declining because of various reasons like pricing pressure or customers discontinuing or want of team. There is a high possibility that this 5% also will not sustain. That might go further down. Or they can go back and say, yes, this particular customer is on the verge of terminating the contract. So even that 100 crore may not sustain. So one, we have to give kind of an assurance to our clients on the underlying numbers, whether it is correct. Second, whether it is sustainable. The second aspect is we also look at various business risks and transaction risks, which is something that we also communicate as part of diligence reports. Now, what are business risks? 80% of my business is coming from a single customer, and the customer has the right to terminate the contract by giving 1 month notice, right? Then that is something sticky for me. Then as a buyer, I may want to meet the customer before I consummate the transaction, because let's say the customer doesn't like me and tomorrow he discontinues. 80% of the business gets wiped off, right? Or, there could be a lot of vendor contracts or customers where the contractual terms are not agreed, right? In writing, it might be a promoter run business. I may be handling it, on a day-to-day basis through a personal relationship. But when an ownership is going to change, it gives comfort to the investors if things are formalized, right? But these are business risks that we pick up and we highlight saying, hey, listen, why don't before the transaction closes, let's give them some time by when they formalize all these documents. And after that, we transfer the consideration to them. Transaction risks could be the company is an old company. There are some non-compliances, let's say in terms of tax or GST or even secretarial compliances, which are things that cannot be fixed, or if it has to be fixed, there is a high amount of exposure involved. Then in which case we tell the client saying, this is the transaction risk. So maybe you don't buy the shares in the company and you then become the own, you don't take over the risk. You rather ask the company to sell the business in assets or as, a slump sale. So this is the second aspect. The third aspect is the valuation itself, because the valuation typically, gets pegged either to the revenue or to the underlying margins. And the fact that we are going and doing this exercise to comment on the sustainable revenues and margins, it also has an implication on the valuation. Also, the business risks and transaction risks that we identify typically are used as a negotiation mechanism on valuation.
How to analyze which is preferred to finance a deal using debt or stock? What factors to look at?
To finance a deal, it will depend on the availability of capital, right? The general thumb rule, as we all know, debt is generally cheaper than equity, right? If you have access to debt and you are getting debt which is at a cheaper rate, and that debt, when I say cheaper rate, it is not just cheaper vis-a-vis your equity, right? What is very important to understand is how much IRR is that asset that you're proposing to acquire is expected to yield, right? So if I'm expecting a 10% return, then I can't go do a debt deal at a 15% cost of debt, or for that matter, equity, right? I will do an equity only if at least if my existing business is giving me, say, 20% return. It makes sense for me to go do a deal only at least if the 20% return is maintained. If I have to do a equity deal or a deal from my cash reserves, right? Or even if, let's say, I raise equity to do the transaction, typically any equity investor will, look at a higher return, right? At least 20% and upward. So unless we are confident that that particular acquisition is going to give me a high return, to try and do it as a debt transaction if I have access to debt. I mean, leveraged buyout, right? It's a very popular concept that everyone looks at. And when I say IRR, it's the cash that the business generates. It's not just the unrealized increase in valuation. Your business should be able to generate that cash to service that debt. So if your IRR on your investment is higher than the cost of debt, and there is sufficient cash flows that can be generated from the business to service the debt, then going for a leveraged buyout or a debt deal makes more sense than going for an equity deal. You should only look for going for an equity deal only if there is a substantial gain that you foresee, or there is no access to debt.
Next is what database can we use to study the deals happening in markets, especially when financial details of the deals are not disclosed?
There are a few. There are certain databases which are paid. There are certain which are free. Paid ones are Capital IQ, VC Circle, VC Edge. Then there are some unpaid ones like TraxAid. Then there are normally what happens is you can even use AI for that matter, and you can write a query and AI will give you currently the published deals which are disclosed in the social forum. But the difference between using a paid database and an unpaid database, Paid database, what they also do is they go and look at the MCA filings. So they will have more data around what was the revenue of the company, what was the underlying margins, what was the deal value. Whereas if you're using a free platform, you can either use AI or you can just Google it, or we can use VC Circle. You can use TrackSaid, if I remember the TrackSen or TrackSaid. So there they will collate these information and provide it to the extent these companies have disclosed these transactions in the social forum. So let's say if they have not disclosed the valuation, there is no way for you to find the valuation. But what you can always do is you can go to MCA, see what filings they have done, and then, from the board minutes or from the valuation report, you will be able to take the valuation. But yeah, these are some of the things that you can use. But yeah, the paid ones come with a bit of a cost. They're not they're not cheap. Yeah.
Right. What is the basis of fixing a multiplier on revenue? And normally, is there a standard range of multiplier to apply?
There is no theory or a standard basis. It will depend on the sector that you are looking at. It will also depend on the stage of the company, whether it's a pre-revenue company, early stage company, or a mature company, whether it's a growing company, degrowing company, and also the sector matters, whether it's services or it's manufacturing. Is it working capital intensive? Is it capex intensive? But one way of looking at it is you try and look at companies which are there in the listed domain, right? And then you will have to do some discounting. Listed companies always carry a premium because there is no liquidity risk. There is no, size risk. They have access to, capital. Whereas an unlisted company may not have those leeways. So what we normally do is you look at a similar company in the listed space. So they will have a particular revenue multiple or an EBITDA multiple or a PE ratio or a PBT multiple. But typically what happens is whether you use a PBT multiple or an EBITDA multiple or a revenue multiple, the valuation will only be a range. I cannot have a 100 crore valuation based on a revenue multiple, and then I can't have a 200 crore valuation based on an EBITDA multiple. Your multiples will change, but the range will be a very similar range, whether it's a revenue multiple or an EBITDA multiple. You can see that in a lot of these listed companies as well. So you take those multiples as benchmarks and you apply certain discounting. If there is a customer concentration in the company that you are looking at, you discount the listed company's valuation to arrive at a value for your target company. You will also, discount some for liquidity risk. You will discount for size risk and any other risks that you perceive when you assess the company. And that's how we can go about getting an implied valuation. But yeah, there is no standard science. We will have to look at it on a case-to-case basis.
So they're asking more elaboration on financial reporting requirements that companies must adhere to before and during and after merger and acquisitions.
Okay. So now as far as strictly financial reporting goes, there is no statute that mandates what financial reporting has to happen from an M&A perspective. What is required is we do the statutory audits if the company has to do a stat audit. If they have to do an internal audit, they'll have to do. So whatever they're required to do statutorily from a reporting perspective, be it stat audit, internal audit, your tax audit or GST audit, you are expected to continue doing that, whether the transaction happens or not. Apart from that, it will also depend on, you will have to assess who are the stakeholders in the company. Now, let's say the company that is proposed to being sold, apart from one promoter, let's say there are multiple promoters, or there's a family of the promoters, or there are already existing investors, then it becomes important that the communication on the deal has to go to them. Their consent has to be taken before you actually progress to the deal. Because at the end of the day, I mean, there is nothing stopping you from going forward with the deal and disclosing it at a later stage. But typically, you don't want a scenario where they say, I'm not okay with the valuation, or I'm not okay with the numbers that you have given. They may have a different view. So it's better that that communication goes ahead. You will also have to look at other stakeholders, like customers, your bankers. Pretty much 99 out of 100 banks have a standard clause in the sanction letter these days, where they say if you have to do a transaction, a prior intimation and an NOC is required from your banker. So in which case, before you ink the transaction, you can do your negotiations, but before you ink, it's important that you report and take the consent from the bank. Sometimes your customers also require you to take an NOC from them, because they don't want, in an unlikely scenario where you get acquired by one of your competitors and they don't like that competitor, right? So then customers also ask for an NOC. So those are things that we'll have to look at. And once the transaction is done, there are certain reporting that we will have to do, more specifically on the valuation of the transaction. So depending on the transaction, you'll have to see what sections apply for valuation. It could be income tax, it could be FEMA, it could be Companies Act. So depending on which statute requires us to submit a valuation report, we will have to get that done and file it. Apart from that, we will also have to carry out the required the board meetings and the EGMs or AGMs to consummate the deal, and that filing also has to go to the MCA. You will also disclose the deal construct in the MCA filings, that you do. Apart from that, there is no intimation or communication that you have to do, let's say, to a tax authority or to a GST authority. In some transactions, what happens is, during the deal, some buyers insist that the seller gets a Section 280 clearance from the income tax authorities, which basically means tomorrow after the deal happens, the income tax authorities cannot come after the buyers for any undisclosed tax liabilities or historical liabilities. So that, depending on the deal, depending on tax exposures that the deal has, some buyers can insist that, in which case you may have to go file. And when you apply for a Section 280, you will have to give certain disclosures in terms of your balance sheet, your P&L, your net block of assets as per IT Act, and determine the net asset value. And you'll have to give that to the tax authorities. You'll have to give a summary of all the open assessments. Then they take a call. They may ask for additional information as well. But that's something that happens during the process of diligence. I mean, during the process of the transaction.
We've got many questions, ma'am, today. So next is, how do chartered accountant assist in negotiation and structuring of purchase price adjustments? Earnouts and other mechanism to align the interest of buyers, sellers in M&A transactions.
Okay, so it's quite deep and varied, but I'll tell you where we get involved. We get involved initially at what we call a term sheet stage. If you are hired at that point, if you are an investment banker to the transaction, or if you are advising your client who is a seller, and you're a chartered accountant and they're reaching out for some inputs, right? The first point where our input comes is at the term sheet stage, or the initial deal evaluation stage. And now let's say you get a particular valuation, or let's say you're on the buy side and the seller says, I want so much. Some of the simple things that we can do to kind of see whether the valuation is justified or not is to ask for a business plan, look at the assumptions used in the business plan to see whether it's sustainable or not sustainable. We can do a DCF to see how much cash the business will earn, assess the payback period, assess the IRR, right? Let's say if I'm thinking of doing a deal by a leveraged buyout, then I don't want a deal where the asset is going to give me only 4%, 5% return, because the cost to service the deal through debt is going to be much higher. Or you can look at some of the comparable companies where transactions have happened either in the listed space, or we can even do a AI search or a Google search to see how similar companies' valuations have been placed. Then we use that as a basis to go negotiate, right? So now let's say for a 20 crore company, which is generating 3 crores of cash, let's say the seller wants 100 crores, right? It's going to take you more than 30, 40 years to repay, that investment, right? It doesn't make any deal rational at all. So that's where you kind of do these IRR exercises, DCF exercises, look at the B plan, also look at what synergies can come merging two entities together. That sort of forms a premise. And once you have that, that sort of helps you get an indicative start level valuation, which will either be pegged, to a revenue multiple or an EBITDA multiple. Then you do your diligence process. Then let's say we come to know that from diligence, the profit is actually not 3 crores of profit, it's only 2 crores of profit. Then you go back to the seller and say, you committed 3 basis, which I gave you a 10 crore valuation. It is only 2, so I will proportionately reduce it, or I'll adjust the valuation multiple. So that's how you can go about it. And also normally what we use also from a negotiation point is some of these business risks that we get, right? Like typically a company where there is a high customer concentration may not get a higher valuation multiple than a company which has multiple clients and they have hedged their customer concentration risk. So those are things that you have to look at and then, suitably advise on the negotiation.
On the similar line, they are asking, can you discuss the importance of financial modeling and forecasting M&A advisory work, and chartered accountant utilize these tools to support decision making?
Yeah. So your financial model actually becomes it's as equal, or in certain cases it's more important in the transaction, because whatever deal strategy that we are putting through, right, ultimately it has to make sense when it boils down to numbers. And your financial model is that end output that is going to tell you, saying, okay, I'm going to buy this guy, I'll get this market access, that market access, I'll get everything. But whether in the larger scheme of things, does it make sense when I look at it as a combined operation? That output comes from your financial modeling. Now, what typically happens in a transaction is there is always a financial model that the sellers give as a base case. We do a diligence, so which means we get an understanding of how historically the business has grown, how the team is, what the business risks are, what the growth drivers are. Then we assess based on what we've understood of the historical business, and we extrapolate it to the business plan what the seller has given, to see whether the assumptions that they have taken make sense. So for example, historically, let's say the company has grown 5% year on year, and then suddenly they are saying I'll grow 20%. Then we need to understand what has changed such that the company is growing from 5 to 20, right? There has to be a rationale to it. So those are things then you'll understand. Then what we do is, if you're on the buy side, you take that model to your drawing board. You have your B plan of your client. You take your analysis, you will take the seller's B plan, you will do some sensitivity analysis, you will beat down the business plan, or you will bring in some synergies. So let's say post a transaction, you don't need 2 HR teams operating, or 2 supply chain teams, not being required. Right? Then you have a cost saving that comes, which you typically don't go tell the seller. It is something that you see as a leverage, and you see it as your synergy, right? So you try and do that internally. And what also happens is we keep, as the deal progresses, and like I said, right, a deal can happen in 2 months, a deal can happen in 18 months as well. So we keep also validating our business model by checking out the outturn. So we keep on frequently getting what the periodical results have been. And we use that to see whether our hypothesis holds good. And I mean, typically, your modeling work, we predominantly do it in Excel. And it helps if you make a dynamic Excel model where, if you change the assumption, automatically your P&L, balance sheet, and cash flows should automatically, change across. And, that helps.
And next we have is, what is important, whether AI derive final decision or judgment as a professional and as a businessman?
I would definitely say judgment as a professional and as a businessman. See, AI is something which is still very nascent. It can pull stuff from various sources on the internet, and then it can put. It doesn't still have the capability to say what is right, what is wrong. And again, AI as a tool is only limited to giving you information based on what you feed it, right? You may have 10 things that will come into play when you look at making certain decisions, which you will not be able to feed into the AI. Right? So always professional judgment becomes very important. And as professional advisors in a transaction, our role is to equip our client with the correct information in the quickest possible time so that they can take a decision on whether or not they do the transaction, right? Because even between a business owner and ourselves, we may not have all the facts to take a decision on behalf of the business owner. So as M&A professionals, we don't take a decision on whether a deal has to go through or not. The decision is always with the business owner or the buyer or the seller, because they may tell you 10 things and they may have 15 things on mind. So it's impossible for you to assess everything holistically in their perspective. So AI is definitely not something that you should rely on. It can be a good reference point to start with.
We got many questions. So within this limited time frame, it was very difficult to, accommodate all of them. But I hope we did justice to our members who are participating today, ma'am. And with this, we come to almost an end of this session. I'd like to take a moment to express our sincere gratitude to Ms. Kanak Dhara for this incredible informative session on merger and acquisition, role of chartered accountants. Ma'am, your insight on this topic were very helpful, and I'm sure our members found your presentation very valuable. On behalf of the entire CLCGC, Corporate Laws and Corporate Governance Committee of ICAI, we thank you for sharing your expertise with us today. Thank you so much, ma'am.
Thank you very much. And I hope that the webinar has been useful. And I'm like really looking forward to seeing more and more CAs take lead on doing a lot more work on the M&A spectrum. There is so much opportunity, and I really hope the webinar added some value to everyone. Thank you.
Definitely. And I would also like to tell our members, in case you want this presentation, you can drop us a mail at clcgc@icai.in. We will share the presentation with you on this. There are many members who have been asking for it. So I will repeat the email ID, clcgc@icai.in. Please drop us a mail. We'll share the presentation with you. Thank you so much, ma'am. Thank you.
Thank you, everyone. Have a good evening.